How much is your business worth? How do you increase the value of that business? How do you even do a valuation in the first place? I'm honored to be joined by Bharat here, who values businesses. He's done over 4,500 valuations. That's one every business day effectively for the last 18 years. He's done over $2.6 trillion in valuations with some big names that we'll hear in a minute. So I'm honored to have him here to answer those questions and a few more. Bharat, it's amazing to have you. Welcome.
Thanks, Leo. It was great to see you again.
So I'm gonna ask that you name drop a little bit. What are some of the big things that you valued over the years, over your career?
Right out the gate, you want to embarrass me. Some of the interesting assets I have valued over the years are the Golden Gate Bridge, the Alaskan Pipeline, Atlanta Airport, Uber, Airbnb, Twitter. Name keeps going on and on.
Yeah, thanks for sharing. I mean, we obviously have somebody here that knows what they're talking about. So let's go ahead and ask what may seem like a very obvious question, but I'd like to ask it nonetheless. What is a valuation? I think it's easy to misunderstand it. Can you break it down for us?
Valuation is nothing more than just an opinion. So I am one of the few lucky people in the world who gets paid for his opinion. So imagine going to a conference of valuation people where you have 1,000 of us in one room trying to come to a consensus, and we're all paid for our opinions. You think we can come to a consensus? Never happens. So that's all a valuation is. It's just an opinion.
That's beautiful. And that opinion, what good is it? What is it used for? How can people utilize it?
The four pillars of valuations, as I call it, or four intended purposes, are generally transactions. If somebody wants to buy or sell an asset could be classified into multiple things. If somebody has a need for a tax valuation, could be for estate planning or could be for other types of taxes, or could be for litigation if there's a dispute of some kind related to an asset, or the fourth is for accounting or financial reporting or audit.
Makes sense. So let's say somebody wanted to transact, and this is a question I get all the time. Somebody has a business, that business maybe has $1 million to $5 million in revenue. It's growing, and they realize they have something of value, and they want to figure out, one, how much is it worth? And two, the question we'll get to a little bit later, which is how do you increase that worth? So what does it look like to actually figure out the value of a business like that?
Actually, valuing a business is very simple. You just got to put yourself in a buyer's shoes, not as a seller. Put yourself in the buyer's shoe and think about it that, okay, how much would I pay for this business if I were a buyer? Now, most people cannot get into that avatar. So there are multiple ways of thinking about it that, okay, what kind of cash flow does this business give me? Or how are similar businesses going for in the market today? Or if somebody were to recreate this business from the ground up, what would it cost them? To really break it down in simple terms, buyers pay big money for businesses that have only two things, and the rest is all bullshit. One, buyers are looking for predictable and reliable cash flow. Number one, buyers are looking to not do anything to enjoy that predictable and reliable cash flow. That's it. So two things, predictable and reliable cash flow, and the buyer can sit on their butt and enjoy that cash flow. And the closer and closer you bring your business to those 2 points, the higher your valuation is.
That makes a lot of sense. And let's dig into those. I mean, because that helps answer the question of how do people increase the valuation of their business going backwards. Somebody having minimal involvement, literally just essentially buying the business or investing in it with a group of people and then just being able to see the benefits. That then, I assume, means a business is largely automated. It has people in it that are going to stay within those roles once the business transacts. One thing I'll say, by the way, and I'm curious to hear your thoughts on this, often when somebody has built a business, they're planning on exiting the business, of course, once they sell it. But if they can't properly exit the business and have the business still continue the way that it did before, how does that affect the valuation? And what can the person selling the business expect? I mean, I've heard of something called being captive, what can they expect if they can't properly pull themselves out of the business once it's sold?
If somebody can't pull themselves out of the business, and many times they say they are the business, well, nobody's going to buy it, because what they're selling is not a business, they're selling a job. And no investor wants to buy a job. They're looking to buy a business that runs by itself. Now, I understand it may not be able to run 100% by itself, but how close can you get to that 100%? That's the real question. So you can introduce automation, you can have awesome levels of management, you can have a very loyal customer base, or you could have certain barriers to entry in the market or the industry. These things make your business value higher.
That makes sense. And those are some great examples of things that people can do to get the business to that point. Let's talk about the consistent cash flow, because it's something that I know we're all familiar with is sometimes when a business is sold, things change suddenly. Those customers that they expected to continue maybe don't. So can you tell me a little bit more about what makes the cash flow really attractive? And then also maybe what are some things that people may think make a cash flow attractive, but actually don't? Like, for example, that customer base that's loyal to the owner, that when the owner's gone, they go away.
So if you recall, when Uber came out, right? Uber, when they came out, they used to only have a la carte service, right? Use as you go, right? You order an Uber, it comes in, you use it, move on. Then Uber introduced this some kind of a Uber ride club fee, or DoorDash. You get a membership for $10 a month, and they waive all their fees. What is that? That's just a membership, or that is just to make the cash flow for that business more consistent and more predictable. So when a potential buyer or a potential Wall Street investment banker, when they're looking at their cash flow, they can easily predict what that cash flow will look like from 3 months from now, 6 months from now, or maybe 2 years from now. And that's what a buyer or an investor is looking for. They want to know what this cash flow is going to look like 2 years from now, not a month from now.
That makes a lot of sense. And something that I talk about on occasion are the 12 different forms of value. And you talk about subscription, and that's a perfect contrast with something like a product business, where if somebody's coming in and really just transacting once, that's really tough to predict what the business will look like 2 years from now.
Mhm.
But on the other hand, when they have a large amount of subscribers and that's something that they're controlling, then that's something that makes sense, would seem a lot more valuable.
For
Well,
example, if you sign up on Zoom right now, right, it's $15 a month. Or if you sign up for the year, they give you 15 or 20% off. Why? Because they want that predictable cash flow. They have your cash up front for the next 12 months.
mm-hmm. That
And
makes a lot of
even though
sense.
they're giving you a discount, an investor values that cash flow more long term.
That I really want to highlight that even though they're discounting an annual membership, it's worth more when it comes to terms of valuing the business. That's awesome. That's really, really helpful. There's a phenomenon that I think would be a good thing for us to close out on. And then, of course, I want to make sure that people know how to get in touch with you and how to move forward. There's a phenomenon where, and I hate being the person to have to break this bad news to people, where people think that they have a business that's worth a lot. And they come to me and they say, oh, this business is worth millions. And then doing some basic analysis, it really isn't. I mean, for example, those two things that we just talked about, it's a job, not a business. And two, the cash flow is really not predictable. Can you tell me a little bit more about that phenomenon? I know you've got some good stories there.
Well, I would like to be invited back, so I don't know if I should tell you this story, but so these are stats, and these are stats from SBA and U.S. Department of Treasury. Okay, I just remember it because I was most surprised when I heard these stats myself. So 94% businesses that are registered in America have revenue of 5 million and under. 5 million and under, 94% of businesses, right? If your business is, say, 5 million, let's not even think if it's lower than 5 million. Say if your business is 5 million, an average $5 million business is probably running a $500,000 in EBITDA. Okay. Average $500,000 EBITDA business sells anywhere from 3 to 5x on EBITDA, right? So let's take an average. Let's say 4x, right? So 4x times 500,000 comes out to 2 million, right? So you say your business is worth 2 million. Now let's assume you're able to sell this business for $2 million as an all-cash deal, which you know that never happens. You always have earnouts or something or some kind of a discount. But you are one of those, lucky SOBs, and you are able to sell your business for, say, $2 million. $2 million minus taxes and cost of transaction, about 45%. So $2 million minus 45%, you're left with 1.1. An average entrepreneur who's running that $5 million business has about, say, $200,000 in debt. Could be college debt, could be kids' college tuition, could be credit card, could be car, what have you, right? But before they go off in the sunset, they want to pay off that debt. About $200,000. 1.1 minus 200,000, 900,000. Now, 60% of these businesses are owned by baby boomers. Right? Baby boomers today are between 55 and 75 years of age. An average boomer is about 64 years of age. Average life expectancy in America is 79. 79 minus 64 is 15 years. So if a boomer is 64 years old and sells this business and gets cash proceeds, final net cash proceeds of 900,000, 900,000 divided by 15 years. $60,000 after tax. Can you and your family survive on $60,000? Now, let's count the assumptions. The fact that you have a business that's revenue of 5 million. You have an EBITDA of $500,000. Somebody gives you 4x on that EBITDA, all cash deal, no earnouts, and your tax burden and cost of transaction is limited to 45%. And you have only $200,000 in debt.
How many
These
people
are
could say
statistics that are very, very shocking, and people don't realize that.
That's a tough awakening for a lot of people. So with that in mind, and I think this is a great thing for us to close out on, what are just a few recommendations and they can be general, because obviously to implement them, they'll need help, but what are some general recommendations that you have for people to increase their valuation and to move closer and closer towards something that they actually could retire on?
Again, make your cash flow predictable and reliable. That's number one. And that sort of goes hand in hand with making your business more and more towards autopilot, right? So push your customers for long-term contracts. Move your business more towards a subscription model instead of a one-time use model. Give your customer the awesomeness experience, or have such trainings, or have some specific trainings that your customers enjoy being with you. For example, why is Salesforce a 12-15x company? I mean, Salesforce is not the only CRM in town. There are at least 200 other CRM companies. So why is Salesforce the biggest, baddest dog in town? Because once you implement Salesforce, and Salesforce is an enterprise software, once you implement it, it's almost impossible to move away from Salesforce, because they got your data, they got your people trained. It is an act of God to move away from Salesforce. That's why it's worth so much money.
That makes sense. Well, I think everybody now knows a bit more about the numbers of what it could look like to transact with their business. They have a good idea of how to improve that valuation and to get that ball rolling. If somebody wants to work with you, maybe for a valuation, they'd like some consulting, just some questions, what are some good ways for them to get in touch with you? And how does that conversation begin?
Sure. The most beautiful thing about my business, Leo, is I don't need to sell anything. People come to me if they have a problem, if they have a need, if I can solve that need. I don't need to sell it. It sells for itself. So the best way to get in touch with me is set up an appointment with me. You can email me, or you can click on the link, and we can have a strategy session and explore if working together is a good idea.
Perfect. So as promised, that link will be in the description. If you have any questions whatsoever, make sure that you get in touch. You've got a fantastic resource here. Bharat Kanodia, thank you so much for taking the time. I really appreciate you sharing your expertise with this audience. This is really valuable information that's going to help people make more money and set themselves and their families up for success. Thank you.
Thanks for having me, Leo.